In this video, traders, we're going to look at, is being a day trader limiting your gains? Stay tuned. Hey guys, a warm welcome to you. All right, so this is a question. Is being a day trader limiting your gains? Let me explain what I mean by this. There's a couple of things to look at. So a day trader, obviously, we know the definition of day trader, taking trades and going flat basically at the end of the day. Now, a swing trader is someone who holds for multiple days. So why would being a day trader limit your gains? Well, studies show, and this is just for the S&P 500, that the majority of gains for a rally period are made in the overnight session. In other words, we get a gap up in the cash, we get moves overnight if we're trading Globex, based on news, based on earnings that are driving stocks up, based on European news, Asian markets moving, etc. And there's studies that have shown this. And so the question then becomes, okay, so if you're day trading, then are you limiting your gains? Because if you're only participating in the day moves, there's a dramatic difference in the kind of percentage return you get. For example, and I know this doesn't make any sense from a trading perspective, but just to frame this, if you were to buy kind of each individual day and not have the overnight gains, the returns are massively under what you have if you'd held the S&P 500 all the way through the bull market or bull run. And so that begs the question that, are we limiting our gains by day trading? Now, okay, if we're trading S&P 500, that might be the case. And so if you're trading S&P 500, or you're trading SPY, or you're trading one of the indices that potentially gaps and you're trading the same thing all the time, maybe it's time to do the research and say, okay, hey, am I doing the best thing I can do possible? Now, there's something to be said that, okay, if I'm day trading, I'm going to be using more size because I've potentially got less risk, I haven't got any overnight risk, etc. So maybe your gains aren't as limited and maybe you can finesse your entry a bit more. But maybe there's a hybrid mode. Maybe if you're studying, there's two things here, isn't there? One is if you're trading the same instrument or specific instruments. If you're trading a specific setup or strategy and you're scanning stocks, for example, this doesn't apply because you're scanning based on some moves, some gaps, some earnings, and then latching onto that volatility and that aggression in intraday, coming out flat at the end of the day. If you're trading, let's say trading S&P 500, DAX, FTSE, any of these indices, it may well be time to think, okay, well, if I'm doing that and I'm potentially leaving stuff on the table, do I need to become a bit of a hybrid? Do I need to day trade but allow myself the opportunity to hold trades overnight? I think that's the sweet spot if you can stomach the risk. Now, I know Forex traders, same kind of thing. A lot of you guys holding stuff overnight, and it's different because you have got that have got that trade that's going all overnight. Yes, it thins out a little bit. Yes, the spreads get a little bit wider, but you're participating in the moves. But if you're trading indices, and yes, I know as well, if you're spread betting or you're trading CFD, they do trade overnight. But the point is, if you're day trading, most day traders, when the bell goes, the closing bell goes on the NASDAQ or the Dow, whatever it may be, a New York Stock Exchange, sorry, then they'll stop trading the Dow, they'll stop trading S&P 500. They won't hold that overnight. So maybe it's time to look and say, well, if you'd held some of those trades overnight, what would happen? Now, this is a very easy thing to do, right? Because you can go back and you can just say, okay, well, let me take 3 months worth of my trades and let me look and see all the trades that I've traded in the final hour or traded right up to the bell. Because very often day traders will close just before the bell. I know that I always have an alarm just before the bell, make sure I can get out of position, unwind it so I can completely be flat. The last thing you want, and we've all made that mistake, is the bell goes and you can't get out of something. Not the case obviously with futures because of that extension, but it's happened before with some markets. LSE is a great example. So even though you do it at the auction period as well, the point is you can miss the exit and go, oh, I'm stuck in a position I don't want. Anyway, back to the point. The idea is that you go back and you say, okay, well, let me see how much meat there is to what this video is all about. Is there any meat or any substance to it that if I'd held some trades, would I be doing better? And you go back and you say, look at all the trades that you closed at the bell. And then you say, okay, if I'd held those trades for one night, what will be my P&L based on doing that? What about if I held it for, 4 hours? Or just have some, don't overdo it unless you've got the facility and stuff to backtest and do all that stuff and it's already programmed. Then great, get as much data as you can. But just going back and manually doing doing that. And then you'll have the results for yourself and you go, well, yeah, actually, because I'm trading that drive into the close, I'm trading that trend day, I'm on the trend day, I'm closing at the end. Actually, if I held overnight, I would get that drive through. Now, of course, that's assuming that that happens on kind of continuations from strong days. I'm going to guess that a lot of times this happens just out of nowhere, and so it could be days that have been relatively quiet, news comes out, gaps up, and you miss that. In which case, you know, from a day trader's perspective, nothing you can do. Or you could, one thing you can do is you can say, listen, it's statistically proven that if I buy at the close and I hold it till the next day, and I did that for the past year, that's a profitable trading strategy. Now, I know a lot of you are going to go, well, that's ridiculous. Bear with me on this, because sometimes you can say, well, if it's a proven strategy, if I can manage my risk somehow, and I recognize that once the bell's gone, you're giving up risk, especially for overnight risk. But there's something to be said for saying, well, you know, if that history has shown that and we're in the same market conditions, etc., 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 then maybe I need to be looking for a buy in the last hour for everything I'm trading, with the view to holding it overnight for that potential gap that I know if I take enough of those, I'm going to be rewarded for that. But if I use my entry skills to try and get a little bit of a head start on it, maybe I can squeeze a little bit more juice out of the trade. So this is what it's about, guys. It's about thinking about stats and stuff that you know is an edge, and then molding it into your existing trading and saying, okay, well, that is potentially something I can use, that is something I can potentially use, or it's not. And if it's not and everything's working out for you, that's fine. But it's just food for thought. The title of the video is Being a Day Trader Limiting Your Gains. Really, it's to start to get you thinking of, okay, well, is there something else I can add to it? Can I be leveraging on something that I know is happening? Like we know we had stats where we had, you know, a good drive in the last kind of hour of trading. Very, very often that's disappeared a little bit now. But last year specifically, that was it. And if you missed all that, you missed out on most of the gains. So it's understanding the market you're trading and adjusting your trading strategy so you're taking advantage of the edge that's present for however long that may be. All right, guys, see you next one. Take care. Bye-bye.